Well, here we are, now officially in the month of February, and the bulls of the market were rightly snuffed right back into place as the market slid by the end of the week. So today, we're going to go ahead and dive right into some need-to-know macroeconomics to understand what exactly happened, urgent news out of the Federal Reserve, as well as economic outlooks from some major Wall Street banks before covering 7 dividend stocks that you need to have on your watch list for their sheer ability to grow in 2024. With that, investors, are you ready? So first and foremost, let's go ahead and quickly cover what we must on the macro level. Now, as I always say, macros matter, but not necessarily for the sake of timing the market. They're really to use to your advantage to understand perhaps what sectors to invest into amidst volatility, which is right now what we're experiencing. Now, of course, given it's been earnings season, and as we always see some higher volume trading, we actually saw over the last couple of weeks a market run up. And that is because some of the companies that reported strong earnings. But really, over the last 2 weeks, the Federal Reserve has also been in their blackout period just before their FOMC meeting. You know, that meeting where they discuss and decide their next chess move against inflation. Anyhow, when there's an absence of negative news and positivity amongst investors, we always see these run-ups. But on Wednesday of this past week, Powell came right out and announced that the Federal Reserve made a decision to hold rates steady. Now, I think many investors had an expectation that the Federal Reserve would begin to decrease interest rates, to which they're currently residing above 5%. But instead, the Federal Reserve went ahead to hold strong in their position, and that leaves the question of when will the Federal Reserve actually pivot and decrease interest rates. And when they do that, it will be the real ticket to the big show, the bull run. However, we also need to keep in mind that we don't want to be too late to the game because, at least how Goldman Sachs sees it, the Federal Reserve is going to go ahead and aggressively cut rates this year, at least 5 times throughout the year, which means that the question remains, when will the Federal Reserve actually commit to cutting those interest rates? And then we also have other questions to keep in mind, like how will businesses fare in the interim until the Federal Reserve makes that move? And then last but not least here is just to keep in mind this question: who are going to be the biggest beneficiaries of interest rate cuts? Now, luckily for all of you, I have 7 dividend stocks that I've been eyeing down, and we're going to go ahead and dive right into them right here, right now, with Genuine Parts Company, ticker symbol GPC, up first, which is a distributor of automotive and industrial replacement parts, as well as electrical components. It's a bit of a behind-the-scenes player across various industries, but we have a very necessary business on our hands. Anyhow, as you can see right now, Genuine Parts Company is down by over 14% on the year, trading for just $140 per share. That's $40 below where it was this time last year, with a PE ratio at 16.1. But zooming out here, we're going to see over 138% worth of appreciation over the last decade, which is not surprising, again, just considering what the company actually does in their everyday role in our lives. Then we also have to take a look at what analysts are saying here, and they're bullish. Over a 10.5% worth of upside expected, coming up to $155 per share. We also see hedge funds who have been buying over 139,000 shares purchased last quarter. However, as dividend investors, here's our real royalty: a dividend yield coming in at 2.71%, which may seem low, but we're talking about reliability here with over 66 years of a dividend streak, while growing that dividend year over year by 6% on average over the last 20 years. Next up, we're going to go ahead and talk about Texas Instruments, ticker symbol TXN. Now, you may recognize that name from their calculators, but the reality is Texas Instruments is an industry-leading powerhouse when it comes to semiconductors, which are a very hot commodity of at least our time right now. And we're taking a look here at Texas Instruments because it is down in the red by 9.24%, trading for just $160.12 per share, PE ratio at 23.5. Zooming out, though, we see over 412% worth of appreciation. That is insane. And moving into the future, technology play like this is only really going to remain, I think, in the green, promising upside from analysts forecasting a share price to rise to $170.11 per share. Now, this semiconductor king has really proven itself as a dividend investor's dream investment, coming in with a yield at 3.25%, dividend streak here of 62 years worth of dividends. But check this out, over 23% worth of growth on average year over year for the last 20 years. Now, investors, there's 2 out of the 7 dividend stocks. Now, the next few are a bit riskier, but I think with plenty of firepower to deliver very lucrative returns. However, before I actually cover them, I want you to take massive action right now by by subscribing to the channel and joining me this year on a financial freedom journey. We're going to do that together. And while you're at it, if this is the content that you came here for, that you're enjoying and you're getting anything out of, go ahead and tap on that thumbs up button for me. With that, we're going to go ahead and get back to it with Stanley Black & Decker, ticker symbol SWK, which is literally the world's largest tool manufacturer. And while everyone is hooked on Lowe's and Home Depot or other mom and pop type home improvement stores, the question is, who supplies them all? And therein lies my thesis when it comes to Stanley Black & Decker. I think it's going to blossom when the economy comes booming back. Now, that's going to take time, but the time is now for us to get invested. If we look into their share price, Stanley Black & Decker is actually up on the year here by 6%, trading for $93 per share. But going back 3 years, we're still seeing red, over 41% of downside there. Decades time, we're seeing 52% worth of upside there. However, I want you to think very long term when it comes to Stanley Black & Decker, because Stanley Black will be back. And a matter of fact, in the near term, analysts are seeing that upside coming up to almost $100 per share. But think about the interest rates coming down and construction really booming when they do. And that's when we're going to be able to collect. And until then, we do get to collect on the dividend. That's a 3.47% dividend yield. It's been on a streak for over 146 years. And more importantly, it's grown by 6% on average year over year for the last 20 years. And if hammers, nails, hard hats, and all the alike just really aren't your thing, I totally get you, and I got another risky investment for you that some of you actually may balk right from the get-go with. But check this one out. It's with Tyson Foods, ticker symbol TSN, which is one of the world's largest producers of beef, chicken, and pork. And now we're taking a look at an industry leader specific to the United States. Now, Tyson has been hit very hard from multiple angles, whether it's been the cost of animal feed rising, logistical matters, or even literally internally with their executive team. But if Tyson can get it all together and wait out the economy, we're talking about some real beef to add to your portfolio gains. And as we speak right now, the stock's down 12.7% on the year, trading for just $54 per share. That is literally probably a fraction of the cost of your grocery bills out there. Now, zooming out, we have over 87% worth of appreciation over the last decade, but this is what excites me the most when it comes to Tyson. Just about everyone balks about Tyson Foods, right? But hedge funds were there to score over 5.4 million shares worth of the company last quarter. Now, in terms of the dividend, we have another solid yield coming in at 3.58%, which remains safe according to Simply Safe Dividends. Now, scrolling down, we can see over 32 years worth of a dividend streak with some nice year-over-year growth here coming in at 13% on average over the last 20 years. But if that isn't exactly your type of gamble, we also have a great opportunity, in my opinion, right now with Archer Daniels Midland, ticker symbol ADM, after the agricultural commodity trader announced a suspension of their CFO, Vikram Luthar, as a part of an inquiry into accounting practices within the nutrition division. Now, internal troubles are usually some of the easiest resolves when it comes to management teams just quickly finding replacements. However, should there be more internal fraudsters, if you will, it could get worse. But usually bad apples, or a couple bad apples, however many bad apples are out there, are literally just let go and the company can rebound. Therefore, invest into this one while the stock is trading for $55 per share. That's down by over 23% on the year with a P ratio at 7.7. Zooming out, we're going to see over 90% worth of appreciation over the last decade. Now, we also have analysts here with a forecast at $60 per share. That's over 9.16% worth of upside. And all in the meantime, a 3.6% dividend yield. It's been paid out for the last 92 years with about 11% worth of growth year over year over the last 20 years. Next up, announcing 12,000 job cuts, United Parcel Service, ticker symbol UPS, has recently made headlines, and of course their move came after package volume slipped last quarter, which makes complete sense in the economic environment that we are in, and ultimately created now an opportunity for us investors to look into UPS for the longer term. As of this video, UPS remains down on the year by about 9.75%, trading for $141 per share, P ratio at 16. Now, that is down by about 20% from this time a year ago, which makes even more sense because there's been a lot of penny pinching in this environment. But the big picture here, over 105% worth of share price appreciation over the last decade, all while analysts are now now projecting over 15% worth of upside with a share price of $164.53 per share, on top of hedge funds who have also been buying. Now, as the stock dropped, we see over 5.6 million shares purchased by hedge funds. And best yet, when it comes to UPS, we're going to go ahead and collect on a solid dividend coming in at a 4.59% yield. That's been paid out for the last 24 years. And check this out, 11% worth of growth on average year over the last 20 years. And then there's arguably the most interesting play for the day here. We're going to go ahead and talk about Wendy's, ticker symbol WEN, which is a fast food chain that's competitive with, of course, McDonald's and Burger King and the alike. Now, I think it's actually the underdog of the mix, but heck, those square hamburgers have made their mark as the company has grown into a larger and larger footprint year, over 7,000 locations at this point in time. But I'll keep it to the stock. It is down by over 10.2% on the year, trading for $19 per share, P ratio at just above 20. Now, we have seen 173% worth of share price appreciation over the last decade, which is nice, but that's not indicative of the future. However, analysts foresee over 14% worth of growth and a comeback here as that share price hits $21.70 per share. And hedge funds, most interestingly here, which is what made me put this one on the list, just bought over 13.4 million shares worth of Wendy's last quarter. Now, as a dividend investor, we do get a nice yield coming in at 5.24%, noteworthy, but we're also going to go ahead and take a look at this growth rate at roughly 17% on average over the last 10 years. Now, investors, there you have it. Let me know your thoughts on these dividend stock picks. Go ahead and comment down below. Be sure to subscribe to the channel to keep up to date with the latest insights, or literally just click right here for more.